What is going on, party people? Thanks for tuning in. My name's Jonah Dew, and we've got two other coaches with us today. Why don't you introduce yourselves?
Ladies first.
Hey, what's up? I'm Liz Durock. I'm here with the Cash Compound. Happy to be here. Good morning.
And I'm Sean King, based out of Pensacola, Florida here. And as always, happy to be here as well. Happy New Year, everybody.
I love it. So what our intention is today, thank you guys for tuning in so far, but what our intention is today is to give you a little bit of insight into what infinite banking is, allow you to ask questions and get some expert knowledge from folks who have been practicing infinite banking for a few years here. I think maybe I've got the tenure on the three of us here today. I've been practicing infinite banking for almost a decade. Liz, how long for you?
Just crossed a year.
Hey, there we go. Just crossed a year. Sean, what about you?
I've been studying it for about 3 years, practicing it for coming up on a year now.
There we go. So I've got a little bit of don't call me the old head. I don't feel old, but I guess in the infinite banking space, that's me. And what we want to do is we want to make sure we give you the opportunity to ask those questions so we can answer them for you, so we can walk through exactly what infinite banking is. So if you're just joining us for the very first time, let me give you a little bit of background, a little bit of introduction into what in the world infinite banking is. Infinite banking, or the infinite banking concept, is a way for you to control the financing aspects of your life. So here's what I mean by that. We've all got to finance things. In fact, I actually believe, with the help of a friendly little book, a black book that I'll pull out a little bit later, that we actually finance every single thing that we purchase. We either give up money that we could have earned by using something like cash, or we just pay extra money by financing or leasing. Just depends. I know you can't lease a gallon of milk, but you surely can lease a car or something else like that. So because we finance everything that we buy, that means somebody's making money off those purchases, right? And so what we want to do when we become our own banker, practice the infinite banking concept, is what we want to do is we want to keep and control the financing aspect of our own life so we can make the money, so we can keep the money that we would have given out to the third parties. And that's what we do here on our channel. We talk about it, we teach it, we give real life examples about the ways that we were using it, are using it, used it last week, used it this week, and that's what we want to walk you through today. Guys, did I miss anything?
I think you're pretty good.
All right. If somebody asked you, Sean, explain infinite banking in 1 minute or less, what are you going to tell them?
Yeah, basically, I'd say infinite banking, much like you were saying, I think you were pretty spot on, but infinite banking is really a financial strategy that allows you to become your own banker by leveraging that guaranteed cash value of your properly structured whole life insurance policy. So instead of relying on the traditional banks or lenders, you use the policy's cash value as your, I guess, private reserve.
Yeah. The people applauding that one. Yeah. People going crazy.
To, private reserve to finance your purchases, investments, emergencies, really just you control your money while your money continues to grow in the background. And the whole idea is being able to utilize OPM, other people's money.
I love it. Liz, what about you? Somebody asks you, what in the world's infinite banking? What are you telling them in 1 minute or less?
Similar to you guys, it is a financial strategy that allows you to recapture the banking function in your own life, cutting out the middleman that is the banker, and understanding that the banking business is one of the most profitable businesses to be in. And that's because your money can be working for you instead of the banks, and leveraging other people's money while allowing your money to grow inside of this properly structured whole life insurance policy, which is the way that we teach here. Although you can practice infinite banking in multiple different facets, but again, whole life insurance is the place to be.
I love it. I love it. The kids love it too. The kids love it too.
Yay.
Okay, so hey, if you're watching, if you're tuned in now, what we'd love for you to do is send us a comment, right? Put a comment in the chat box wherever you're watching about where you are, where you're calling in from, and if you've got an infinite banking policy already, or if you're still learning, right? I'm researching, I'm learning, I want to know, or if your brother, your mother, your sister got one, right? I'm using theirs because I don't qualify. I got the neck, the back. So leave us would. Right, put it in the chat, and we'll give you a nice shout out as we get into it. But what we want to do now is we want to jump into our first segment. It's our infinite banking insights.
All right.
There we go. I love it. Liz, take it away.
Yep, awesome. This week I really wanted to talk about a common question or misunderstanding that a lot of people in the internet space have been coming to me with. I really understand what Jadu, your brother, the other banking bro, talks about when he's out here fighting for his life, especially on social media, because you get all the people saying all the things that they think they know that just ain't so. So that there's this common belief that the cash value and the death benefit are two completely separate pools of money. And I'm not sure if you guys run into that in conversations with people, but a lot of people wonder, like, okay, well, when I die, yeah, my family gets the death benefit, but what about the cash value?
Yep. There's a very popular internet personality out there who has a radio show where people call in, and he's got a really famous clip where he says, when you die, your family gets the death benefit. And then he stops talking. And then he goes, and that's it. They get the death benefit. That's it. All that cash, right? And he starts going about that. And so what's the misconception here, right? People thinking it's separate. The cash value and the death benefit are separate. So we've got to explain to them a little bit about what is actually going on. Like, what is it? Liz, give us a little bit of insight. Why is that not correct? That you're only getting the death benefit? Like, why is that the wrong thinking?
Right. There's a whole army of that famous person out there that goes to swing for him like die hard, which I don't discredit some of the ways that he thinks he helps a lot of people. But in reality, the belief that there's two completely separate pools of money, that's just not how it works. The truth is that the cash value is the equity of your death benefit. It's the portion of the death benefit that you can access and use while you're still alive. And that's what we mean when we're taking loans. We're loaning out against the death benefit, and that is our cash value. If you've seen our 3-cup setup, you see that there is 3 cups, and cup 2 and cup 3 are the death benefit and the cash value. We do that for visual sake. So it does get a little confusing, but the cash value is the equity. And that's how I like to explain it to people, is like thinking of it like a home with equity. As soon as you pay into the policy, your cash value grows, just like you're building equity inside of your house.
That's right.
The death benefit represents the total value, and the cash value is the portion of it that's available to you today.
I love that. Man, Sean, tell the people, when you sell a house, right, when you get the price, you get the cost of the house when you sell it, you get the check, right? It's your house, you sold it. You get the equity also, don't you? Don't you get
I sure do. I'm selling it for 500. I had 300 in equity in it too, so they're giving me an extra 300, and they're gonna throw on another 100 just because they like me.
Just cause, right? That's the craziest part to me when people speak like that. I've got one more, but I'm gonna go off on a tangent real quick. For all the people who are watching, I got another thing, because they preach this when you talk about whole life insurance. People love to come at you real quick and talk about term life insurance instead. And they say you should buy term is what you should do. This very famous internet personality used to just be a radio personality. Now he's an internet personality. He's coined this I don't know if he coined it, but boy, did he make it famous that you should buy term and then you should invest the difference. But you don't do that with anything else in your life. You never just take the cheapest option. Don't care about the value that the thing brings so you can invest the difference. Listen, I was in the shower this morning thinking this through because it made me upset. I was going to make a whole YouTube video on it, made me mad. And I went, if I bought the cheapest shower curtain, it'd be water all over my floor right now, right? You can't buy the cheapest one and invest the difference. I was playing in the studio earlier. I dropped my phone. My phone cracked. I bought the cheapest phone case on Amazon. As soon as it happened, I'm sitting in here with our producer. I said, nah, I bought the cheap one. I did invest the difference though. And now look at my phone, cracked. That's what happens when you buy. You don't do that with anything else. It's value. It's not just cost. It's value, right? And that's what I just dislike it so much. Anyway, that's exactly right. Cash value is liquid today. Death benefit is the payout someday. I didn't get it right. I know if my brother's watching, he's going to be upset. He's got all, but that they're not this. They are the same. They are not different. So you can't sell the house and also get the equity. So saying cash value and death benefit are different, or you should get both of them, is just not correct. That's not how that works. So again, if you're watching us, we appreciate you. This is our Ask Us Anything hour, where we talk and deep dive into what the infinite banking concept actually is. We'll give you real life examples. We'll talk about how we're using it in our lives. And so what we're looking for you to do is just leave us a comment. Throw it in the chat. Tell us where you're watching from. Where are you right now? Is it snowing? Right? We just got off a call with some of the folks in Indiana, and they're saying we've got snow. I'm personally in Greenville, South Carolina, and our snow's coming tomorrow. I know that's crazy down here in South Carolina. Liz DeRock is over there in Washington State, if I'm not mistaken. Liz, you got any snow over there?
Not yet. It's sunny and cold. It's been awesome.
What about Pensacola, Florida? How's Pensacola doing?
Man, we've been getting down in those freezing temperatures, but no snow over here either.
But no snow. All right. Well, our town is legitimately closing down. School's already down for tomorrow. School's done. I told my wife had a brunch, a little brunch date on Saturday. She was like, I'm still going to brunch. And I was like, there's no chance in the world you're going to brunch. Brunch is closed. There's no way you're doing it. But what we've got now is some comments. Sean, why don't you read that one and we'll jump into it?
Yeah, let's see here. It says, I have a policy for a year, even though I'm not able to be insured. So I have my sister as the insurance interest and I'm the owner.
I love that.
Nice. Smart move.
I love that. So, Liz, tell people about what's going on there. And people might not know that that's a possibility. Walk us through that comment that we just read and exactly what's going on, if you would.
Yeah, absolutely. So there's a thing called insurable interest. If you yourself are not insurable, meaning you have some sort of illness, or maybe you just had a heart attack, for example, like my mom, she can not have life insurance on her body because she's too high risk, which that's what insurance is. It's transfer of risk. We are doing life insurance, so they evaluate your health, of course. And if you are not insurable, you can then open up a life insurance policy designed for banking on, say, your daughter, for example, or your sister in this case. And you can act as the owner. Obviously, the insured body has to give permission and know that this is all happening on them. Otherwise, things can get kind of sketchy.
Yep. Can't pull a Walmart, if you will, right? For those of you who don't know, up until about 1988, the Walmart Corporation, the Walton family, was purchasing life insurance on all the employees that signed up for the Walmart benefits plan or package. They were purchasing whole life insurance on them. They got in trouble in 88, which is why I said can't pull a Walmart. They got in trouble in 88 because they were not telling the employees they were doing this. So that is what got them in trouble. So since then, of course, they still purchase whole life insurance on their C-level, right, corporate level employees. And of course, now they're letting people know, letting people know they're doing it. All right. We got another comment coming in. Sean, why don't you take this one again?
I just hit year 3. This coming in from North Carolina. Shout out to North Carolina. Come on and raise up. Let's see. Jonah was my specialist for the first couple of years. So policy year 3, and you were the specialist. That policy's starting to cook a little bit.
There we go. Right.
Yeah.
Starting to cook with grease. I love that. When I heard year 3, this is the sound that came into my mind.
2 hours later.
Right. It's 3 years later is what it is. But I love it. Congratulations and good job. Most of you are going to know out there that after you've had your policy 1, 2, 3 years, that's what Sean means. It's policy starting to cook. What that means is your cash values are starting to gain, are starting to be close to, if not equal to, if not higher than the premiums paid. And so what that means is it takes a lot of stress. It relieves a lot of stress and pressure off of you to pay premiums, right? To deposit the money because you know it's all coming back. So that's a really cool time to be. Congratulations on having that policy 3 years. Great work. Liz, this one's for you.
We got about 8 inches of snow last Sunday. Is that what I'm saying?
8 inches is crazy.
That is crazy. I am not looking forward to the snow, but is what it is. It turns
That's
out
right.
It's cold in Florida too, which is where I want to move.
I love it. Okay, so here's where we're going to go next. I asked a would you rather question to our audience. I specifically put this inside of our Facebook group. It's a group called Infinite Bankers. If you are an infinite banker or desire to be an infinite banker, go ahead and look for that group. It's a private group. We'll let you into that group. Thanks for watching here today. But I asked a would you rather question. I asked it there. I asked it on YouTube. I asked it on Instagram. And we got a significant amount of responses. So I want to pose this question to all who are watching us live. The question is as follows. Would you rather, choice A or choice B, would you rather borrow money from a bank for a new car at 2%, a 2% loan from any bank you choose, or would you rather borrow against your life insurance policy at 5% and pay yourself back with interest? Which would... Which would you rather? Choice A, choice B. Borrow from the bank at 2%, borrow from your policy at 5%. And believe it or not, we got a significant amount of people chiming in on this request. Now, should I tell the people who are watching which one won outright? Or should we dive into it first? Why don't we dive into it first?
Let's dive into it.
Let's dive into it. Liz, you go first here. Tell us what your thoughts are on this question. Tell us what you're thinking. Tell us what answer you'd give.
I hit policy at 5% like right away.
Okay.
And that's because I like the idea of recapturing the dollars that I would have spent on that car.
Now, hold on. If borrowing from the policy at 5% is going to charge you a little more interest than the bank was going to charge you, right? That's the 2% and the 5%. That's the whole question, right? You're still choosing from the policy at 5%.
Yep, absolutely. Because I'm paying my bank back that 5% plus interest.
Okay. Okay.
So
Sean.
Money with my money.
Like money with my money. I like that answer. Sean, give us your take on it. Which would you rather do? Choice A or choice B?
Yeah, I'm 100% borrowing from my own personal bank. Number one, I like to be in control. And if I'm getting it, doesn't matter if it's 2% from this third party. If I don't pay that third party when that time comes, when that money's required, something's going to happen. Somebody's going to repo my car. Something's going to happen. So just off the basis of control, I'll take the 5% without all the other benefits because I'm in control of the loan.
Sean, what about if you miss a payment to your own personal policy? You repoing your own car?
I'm breaking my own legs, man. I'm a serious banker when it comes to this. So
There we go.
something's got to happen.
I guess you can just move it from the front yard to the backyard. They got me. They got me. It's in the right. If you have the control. We've got a comment coming in from Instagram that says that they would also rather borrow the money from their life insurance policy and pay themselves back with the interest. So I think this is super unique. We've got 3 different people now who have said, I'd rather take a loan at a higher rate
Mhm.
than a loan at a lower. Now that's crazy, right? If you get on the internet and that's what your post said, I'll rather take loans at, I mean, banks, credit unions, they make so much, they make so much content, they spend so much marketing dollars trying to say we have low rates. Do they not?
Yes,
We've got
sir.
low rates. We've got low rates. We've got low rates. And we've got 3 people now that are tuning in to say, no, I'll take the higher rate because I value control. So here's what I thought would be interesting. I've got a few comments from this. I've got comments going both directions. So I want to read a few and let's dive into them and talk. Okay. So this is from Jeff on our Facebook group. Jeff says, personally, I would probably take the 2% loan from the bank, the regular bank, knowing that I have enough reserves and access to using it to make double-digit returns on my lending business at the same time. It just seems like the better option to me. Everyone's situation is a little different, though. Let's talk about that. What do we think about that one?
Yeah, I'll take that. Without a doubt. I mean, if that's where you feel like the best utilization of your money could be, if you don't have enough capital to do both things, then by all means, again, you're in control because you can decide whether I want to take that 2% loan or I want to borrow from my policy. So at the end of the day, you're still the one making the decision. You're not backed up against a wall where you're saying, I've got to take this 2% because I have no other options.
Yeah, absolutely.
I like that. I like that. Okay, why don't I read this other one here then? This is from Eric. Eric P. That's the last initial. I'm trying to give you a shout out, Eric, just in case you're watching. Okay, so Eric says, it depends. That's his first statement. It depends, period. He says, my rule of thumb is always actually to have 3 to 6 months of expenses that I've got tucked away before I'm going to touch my private banking policy money. But once that's established, I then just think about my long-term goals. I always tell people that if I have goals like, or if you have goals like investing in real estate, then that should be your priority over tying up your cash on a car loan. So he's kind of saying the same thing that Jeff was saying. He's saying, hey, if you can do 2 things at once, then maybe that's a better option for you, but it just depends on what you'd like to do. Right. He also says, don't downplay the bank giving you 2%. That's extremely good in the current market. And if you've earned that rate via your commitment to maintaining good credit, then that is something you should not take for granted because you've got access to it and most people don't. At the end of the day, if you take the bank loan, but then you get into a bind, you'll have peace of mind because you know you've got the policy money to come bail you out. What do we think about that answer, Liz?
Yeah, I think it's hard to argue with him. Again, you're being your own banker, and I agree. Like, investments, real estate, things that are going to make money with your money is more of a priority. Than buying a car. But if you can do both at a low rate like that, it makes sense that that's his argument. I just want to highlight our Facebook group members. This is what you guys would get. And if you guys come join us over in Facebook, we have a lot of smart people in there.
There we go. Sean, take this comment that just showed up on the screen here.
Yeah, there was one. Are you referring to, I think the interest is paid?
We can put that one up. We can put that one up on the screen. Take it.
Okay, so yeah, it says, I think the interest is paid to the insurance company, not back into the policy. What carrier doesn't? So yeah, that's a great point. And I actually love this point. This is a point I was going to make. When you're when you have a policy with a mutually owned company, that means you are partial owner. You get the benefits of being of the success of that company, unlike a stock company where everything that they're doing is focused on making sure that the stockholders are getting their dividends on a yearly basis, making their income. So you're completely right. That interest, let's just talk about that, that 5%, that interest is going back to the insurance company. But because I'm partial owner of the insurance company, that interest that I'm paying back to them is going onto their books, making their business look good, which in turn, at the end of the year, when they tell me, you know what, this is going to be our dividend. This is what you're getting kicked back. You know who played a big part in that? Me, who took loans, repaid them with interest to the company, and received a bigger dividend because of it. So do you want to be sending your money out to somebody where that doesn't benefit you at all? All the interest that you pay is completely gone? Or do you want to be paying it to your own business that's going to be coming back in through the back door, back into your pocket?
Yes, absolutely. I just got my policy loan interest bill in the mail from my insurance company, and that was my exact thought. I was like, ooh, yay, they're making profit. That means I'm making profit as well.
I love that. I love that. Liz, let's not forget Miss Janet here giving us some comments. Why don't you read hers?
Janet says, borrow from my policy because my policy is 5 years old, so it's performing very efficiently. I'm now getting more cash value than the 5% I owe.
Man.
That's cooking. That's cooking.
I love that.
There.
Okay, I love this answer. This came from Josh Yu inside the Facebook group, okay? Josh Yu inside the Facebook group. He says, easy choice, policy loan. That's his, what he'd choose. Here's why. He gives 4 reasons. He says, I want to talk about the first one. He says, less interest over the entire term. Call it 4 years. I know, lower rate sexy, but do the math and you'll see. So before I go into the other ones, do we believe Josh Yu? Lower interest over 5 years. We've got a car note from a bank at 2%, a policy loan at 5%. Josh Yu says, hey, the policy loan's actually less interest if you do the math. Do we believe that?
Yeah, I've seen the presentation.
The crazy part about that question or his comment is I have not done the math on this particular example, but I do actually believe him. I do believe, Josh, that it's lower interest over time. I know that's the craziest thing ever to say. How in the world would a loan at 5% be lower interest than a loan at 2%? And the difference is because at the same time that you're paying 5% on the loan from your personal policy, it's exactly what Janet just mentioned. You're also earning interest on the full amount of premium you've deposited there. Not only that, you've got the ability to repay that loan at your schedule, at your time frame. It's not amortized, right? Did I say it right?
Nope.
Yeah. I didn't say it right. Say it for me, Sean. What?
I don't know what you said. Now you're making me question how to say it.
See?
Amortized.
Amortized. It's not amortized like they would at the bank or the credit union. It's actually simple interest on your policy. So I believe, Josh Yu, that it's actually less interest. It was an interest proposition. We juxtaposed 2% versus 5%. And I do believe that the 5% from your own vehicle that you control is going to be less interest cost in the long run. Okay, he gives 3 other reasons. He says, second, control and flexibility. Want to skip a payment? Go for it. No late fees, no call from the car companies, no threats of repo. I love that. That's a humongous deal. He says 3, every time you make a payment, the money's ready to use again, much like a revolving line of credit or a first lien HELOC we've been learning about lately with no end date. I love that. 4, he says the option to pay above and beyond the car payment, that just goes to added cash value, assuming that you built in the room. And I love that answer. That to me is my favorite answer. I'm going to go ahead. I didn't heart it earlier. I'm going to go ahead and heart that guy in the Facebook group. That's my favorite answer because all of those things are correct. And if you're just thinking about the interest conversation, you're going to miss that.
Yeah, it's all about the type of interest and where that interest is flowing to. Either away from you or to you.
That's it. Okay, Kevin D has a comment that echoes exactly what you said, Sean. So you ready for this? This comment's for you, Sean. It's coming from Kevin D. He says, keep in mind you are not a part owner of a traditional bank, regardless of rates of return. IBC, Infinite Banking, is not about rate of return. Practicing Infinite Banking gives you options. If you want to borrow from a bank, fine. Just make sure you have enough cash value to buy out the debt if needed. What do we think about that answer?
Spot on, my friend. Good job.
Yeah, that's good.
Good job. Thank you.
They're out here in the Facebook group spitting, aren't they?
Yeah, they are.
Yeah, you guys like
Come join
Luke said, you guys got to join the Facebook group. Request to join that thing because there's a lot of great information in there. And maybe you don't want to hear from myself, Jonah, or Liz all the time. Maybe you want to hear from some other people that may not be people who are offering this to individuals like yourself to get policies. Maybe they're just policy holders that have been practicing and utilizing. So maybe you want a different, different lens on the way that you get your information. And there's a lot of good stuff in there.
That's it. So I'm going to give a big shout out. I'm not going to read everybody's comments. We got a bunch, but I want to give a big shout out to Jesse. Jesse was in there. Jesse says he wants the policy because he wants to control the repayment. Big deal. Give a big shout out to Kevin H, Donice H, Tony N, Hillary M, Blake C, Jacovian C, and Kathy, one of our coaches who you might catch on this live episode from time to time. All were in there with comments. There are about 198 people who gave a vote, and 84% overwhelmingly say they would rather use their infinite banking concept policy. 16% say they'd rather take it from the bank. What do we think about those values? Is that what we were expecting, Liz? 84% from the policy, 16 from the bank. Is that what you were expecting? That's almost 80-20 right there, right?
I would say so. If you become your own banker, you're going to want to use your own bank.
I love that. What we always teach and do here at the Cash Compound is teach people about the attributes, the benefits of becoming your own banker, practicing the infinite banking concept. If you're just tuning in and you don't know what the infinite banking concept is, let me give it to you real briefly. The infinite banking concept is controlling the financing aspect of your life. That way, you do not have to rely on the third-party institutions, the banks, the credit unions, the car dealerships, the whoever else you're thinking of, the credit card companies, in order to make purchases in your life. Now, again, those things are normally associated with the big purchases. I totally get it. But we also purchase things every single day. And if you're using cash money to make the grocery purchases, you're still financing, because you're losing out on the potential interest you could have earned if you kept that money and placed it in a different vehicle. Once you know the vehicle to place it, which we use whole life insurance from a mutual company that pays dividends, we then use their cash value, their dollars, in order to become a banker. We loan just like banks do, because loans are assets to banks, and we like, as Liz said, money with our money, right? And that's infinite banking. So what we're going to do right now is jump into our next section, which is our chit chat.
All righty, guys. So we're going to have a little chit chat, and that chit chat today is going to be about FAQ, one of the most common FAQs that we get. If you don't know what FAQ stands for, frequently asked questions. So we're often on the phone with people. We're often on the phone with people, and these common questions come up. Maybe they've been doing their research on YouTube. Maybe they've been reading some books. Maybe they've been listening to some podcasts. Maybe they've been listening to that gentleman who talks about buy term, invest the difference. But a common asked question is, why would someone borrow their own money? Have Liz, Jonah, you guys ever get that question? Why would I borrow my own money?
I've heard it once or twice. Yep.
Times, yeah.
So the short answer to that question is, you're not borrowing your own money at all. When you take a loan from your policy, you're actually borrowing against the cash value and the death benefit that the insurance company has promised you. I think that's very important to understand. So your money, the premiums that you've paid into the policy, continue to grow in the background. So does that make sense to you guys so far? So clear?
So far, so clear. Not my money I'm borrowing. I think that's why they might call it a borrow, right?
Yeah. I don't usually borrow things from myself.
Right.
That's
So
true. That's a good point.
So here we go. So you're essentially just leveraging your money. So the premiums that you're paying, your premiums, are put into the whole life policy. Like, let's think about it like a deposit, okay? You're depositing into your private banking system. Those deposits then create a death benefit. So you put the money in, it gives you this big death benefit and from that, cash value reserves that you can access. So kind of like the whole equity thing that we talked about with the home. I bought this home. I have this amount of liquidity, equity within my home. And now borrowing against the policy, when you take a loan from your policy, you're not withdrawing the money that you've put in. Just like I said before, you're borrowing OPM, other people's money. That money comes from the general fund of the insurance company. You're taking a loan against your death benefit. So you may see, once you have a policy, if you go into your back office and you check your policy, you may see that your death benefit has decreased a little bit due to the fact that you've taken a loan out. That's because you're borrowing equity from that future death benefit. So again, not borrowing my money, I'm using OPM. What's my money doing? It's still earning continuous compounding interest in the background over and over while I'm out there, hopefully doing something productive with my money, either paying off or their money, paying off debt, doing investments, whatever it may be. But I think that's something that we get a lot, is they just don't understand. And I think you guys did a great job showing the 3-cup setup. If you haven't seen the classic 3-cup setup video, head on over to the Banking Bros YouTube channel, check that video out. I know Liz has redone it. I know I've redone it, but I think visually seeing how the money flows through the steps of a policy when banking with it, I think helps a lot of people get that to click, that light bulb to go on in their head and really understand, like, I'm not borrowing my money. I'm using OPM, other people's money. So I know that was, Jonah, with you. I know that was something you faced a lot early on in your career, trying to explain to people. That's why you guys came up with the 3-cup setup, is,
That's it.
hey, we got to somehow figure out how to get people to understand that they're not using their money.
That's it. Before the 3-cup setup was born in my head because people kept asking me the same questions. That question specifically: why would I borrow my own money? Why would I borrow my own money? So I came up with the 3-cup setup at basically around the same time I came up with this analogy that I actually want to play with Liz. Liz, will you play along with me? Would you please? Okay, cool. So Liz, I want you to go to your local bank, your local banking institution in your town, Washington. I want you to drive up to the ATM and I want you to deposit $1,000. Feeling good?
Feel good about that.
Okay, I want you to come back the next day, go to the ATM. I want you to withdraw $200. Would you please tell me how much is left in your bank account?
$700.
1,000 minus 200, Liz.
Oh yeah, sorry. 800.
$800. Okay, $800 left in the bank account, right? Okay, cool. So now we're going to go the next day. So we've got our $200. We're going to go the next day. We're going to go inside the bank. Okay, this is day 3. We went inside the bank and we got a $200 loan, $200 credit card. Would you please tell me your bank account balance?
$800.
$800. Hold on. 2 days in a row, you went to the bank, and 2 days in a row, you came home with $200. Did you not?
Yes.
Yeah, but one time it came from your money, and one time it did not. See, one time they'd call that a withdrawal, and the other time they'd call that a loan. There is a difference. I understand that they both came from the bank. I get it. But they're not. They did not come from the same place. And that's what I wanted to make people understand.
Love
when
it.
we talked about the 3-cup setup. Yeah, I know it came from the insurance company, but it didn't come from the same place. And that's what's important about understanding. You're not borrowing your own money. Why would it be called a borrow if it was your own money? That would be called a withdrawal, right?
So true. So true. I love that.
There we go. So that's our little chit chat, our little FAQ. Any other thoughts or comments on that one?
Yeah, just to touch on the fact that you're loaning that money, you're taking a loan, you're receiving a loan, which is why that money is going to be considered tax-free.
Mm-hmm.
If I were to withdraw my money from my policy, I can only withdraw up to the basis amount, which is the amount of money that I put in there. If I had more cash in there than I had put, and I wanted to withdraw that larger amount, more than I had put in, what's going to happen, Jonah?
Well, first, you're going to get taxed
Mhm.
right? And secondly, I think after a certain point, they're not going to deem it a withdrawal. Like a withdrawal is going to be what you put in. Of course, that's how withdrawals work. And as soon as you come over that amount, it's taxed because it's no longer a withdrawal and it wasn't a loan. But I don't remember what they call it after you get past that. Anyway,
Either way, we're getting taxed, and I don't want
either
to
way, you're getting
on any of
taxed
my
because
money.
you didn't put it in and it's not a withdrawal and it
Don't
wasn't
do
a
that.
loan. So now you got to get taxed. Right?
So
It's simple rules. We understand these rules when people break it down for us like that. But if you're not paying attention to it, as soon as we put it inside of dividend paying whole life, all of a sudden we forget all the rules. We know the rules.
Yeah.
If you didn't put it in and you tried to take it out, it's either a loan and no taxes, or it's not and you're getting taxed.
Yep. And let me know last time you got taxed on a loan. I remember getting a loan for school for, help pay for my college.
Mm-hmm.
Didn't tax me on that. Boy, if they would have. I mean, started taking some
I saw
payments.
somebody's post recently that said, I am not paying these student loans back. The government's got to learn some responsibility. Ain't no way they should have gave $30,000 to an 18-year-old with no job.
Was that you? Did you post it?
No, I didn't post it, but I felt it.
I feel it. Yeah.
I said, yeah, that's a good call. They got to learn. They shouldn't have did that.
Mhm.
Not getting that money back.
Yeah, that's bad business on your guys' part.
Right. Bad business. I love it. Well, thank you guys so much for joining us here today. If you are just tuning in or you've jumped in late, let me explain a little bit about who we are. My name's Jonah. We are hanging out today with some other coaches on our team, Sean King out of Pensacola, Florida, and Liz DeRock out of, I don't know your city in
Vancouver.
Washington.
I'm Vancouver, Washington.
Vancouver, Washington. And we are talking all things infinite banking. If you don't know what infinite banking is, it is the opportunity to become your own banker and finance all of the things that you need to finance in your life. It is an opportunity, as we say here at the Cash Compound, to save money and spend money at the exact same time. But like we just dove into, it's saving your money and spending someone else's. It just so happens to be the insurance companies. There is no loaning your own money happening over here. So that's who we are and what we are doing. And I want to take a few minutes now just to make sure that we get everybody's question answered. So if you're watching on YouTube, on TikTok, on Instagram, on Facebook, leave a question in the comments. If you want us to answer it, we are going to jump in right now and make sure that we answer any and all of them. If you can give us a heart on the video wherever you're watching, we would surely appreciate that also, right? Appreciate some love. But what we want to do now is we want to make sure we get all of your questions answered. I've got some of our social media pulled up here also because people leave comments and questions over there all the time. And although I can't put those on the screen, I'm going to read them. So that way we can make sure we get everything answered for everybody. So a little bit of a Q&A time. Here we go. Okay. I've got a question for Liz. This question, I want to find a good one for you. I found one for Sean because it's about something that he said earlier. But I want to find a good one for Liz. So I'm looking at our YouTube comments here currently. And I've got a question for you, Liz.
All right.
Okay. This is from someone who says, I can't make out their name. It's got too many letters and numbers, but here's the question. The full amount of your premium paid inside of a policy does not actually go to your cash value for a lot of years. He says the guaranteed interest and the dividends that you get from mutual companies is then paid on just the cash value, not the entire amount of your premium. After about 10 years, the amount that going into your cash value will finally be greater than your premium paid. So why in the world would you say interest and premiums paid is your money plus more? The last sentence might be confusing. Let me go step by step. The first thing that he said that I'd like you to comment on is he says that interest and dividends with mutual companies are only paid on cash value. not on your premium. What do you think about that? True or false?
It's false. So every dollar that you put in premium is what gets interest paid on.
Oh, hold on. So I got a question. We kind of just talked about this. Sean gave us our frequently asked question. Why would you borrow your own money? We talked about it's not your money. That's why they call it a borrow. Explain to me what financial institution, bank, credit union, insurance company, I do not care, would pay you interest and dividends on their money.
One that wants to go out of business.
Right. What institution is going to do that?
Zero.
Zero. So with this comment, unfortunately, I can't make out the username. I wish I had a first name and a last initial so I could be on point like everybody else. He says you only get interest and dividends on your cash value, but cash values their money. What institution's doing that? No chance in the world. When you pay your premium, that's your money. Therefore, if you're going to guaranteed interest and a bonus, a dividend on it, I bet you it's on your money, not theirs. Right? Got to make sense. Okay. We've also got second part to his question. It takes 10 years for the cash value to be greater than the premiums paid. What are your thoughts on that one, Liz?
He might be talking about like a traditionally built whole life policy. Perhaps it might not be we're not talking about traditionally designed whole life policies. We're talking about specially designed and engineered policies that equate to higher cash value days in like right away.
There you go. And then lastly, he says, so why would you is the last thing. So it's not really a question. I'm going to phrase it into a question. He's basically trying to call us out. Yeah, Sean, this one's for you. He's saying, so why in the world would you say that interest and dividends are paid on your premium, on all of your premium? Why? What are your thoughts on that? Why would we say that?
Because that's what happens.
I love the answer. Because that's what the paperwork says, right?
Yeah, the contract. This is the contract. We're just looking at the contract. I go
right, I'm just reading. I'm a very good reader. I've realized, and I've once I started helping people with infinite banking, I realized that not everyone should and could claim that. They do not read well. I'm a very good reader. I'll just read what it says, and if it says guaranteed at the top, I'm going to make a video that says, hey, they said it was guaranteed. Don't be mad at me, be mad at them, but they said it was guaranteed. Right? It's at the top of the page. Okay, we got a comment coming in. Let's see. I was going to do this one first here. This is from somebody saying, how much to start? How much to start? Sean, you're up there. You got the big face right now. Give him us an answer.
Yeah, how much to start? That's also a FAQ, a frequently asked question that we get. And first things first, if you're asking how much to start, we want to get you educated, because once you read the book, watch some videos, you'll understand it's not how much to start, it's how much can I start with? How much can I put in? So the mindset there flips. But if you had a gun to my head and you were like, man, I want to start this policy, how much can what's the minimum I can do to get it going? In our professional opinion, building these policies, we would say 10 times your current age is the minimum place that you would want to start to have a sufficiently functioning infinite banking policy. But again, once you understand, I want to do way more than 10 times my age.
There we go. I love the answer. You can start with anything you like. We prefer 10 times however old you are as a good place to make sure that you can get a banking policy you can actually do something with, but you can start with anything you like. This question, I'm going to take this one. Okay. You guys been through the branches of banking. What?
Trenches.
The trenches of banking. Sorry, it's far away from me. I can't see it. Is it what bank to start with? What book to start with?
What bank to start with?
What bank to? I love it. What a good question. Okay. Thank you for asking. So here's what you need to do. If you are interested in getting started with infinite banking, what we would prefer is that you click the link in the description of this video, click the link in our bio, and just call us and we'll help you get started. But here's why that's important. And here's why that's the answer to your question. You actually cannot go down the street to your local banking institution, insurance company, and get a policy like we're talking about. You've got to go through an agent who knows how to set up the policies that we're talking about. Here at the Cash Compound, we are authorized infinite banking practitioners, which means that I had to study for the test, I had to pass the class, I had to take the exam to pass, to make sure that I know what I'm doing. So when I get on here on these lives and talk to you, you need to know that I'm certified, right? Stamp of approval, whatever you want to think about in order to be able to help you with the infinite banking concept. So legitimately, it is free. There's no cost. Click the link, set a call. Once you get on the call, say exactly what you just said. I think I might want to get started. Can you walk me through it? And we'll literally just walk you through it. That's it. That's it. No cost. At no point is also, let me be helpful. There's no cost at any point. That's important. Some people are like, oh, the call's free. But after I get through the call, they got to pay. Right. And they expect us to be like, got him. Right. There's no got him. There's no got him. It's free. Just give us a call and we'll be more than happy to help you. Okay. Liz, this one's for you.
So there's a guaranteed interest and annual dividend. Yes, sir.
From Jordan on TikTok. Appreciate you, Jordan. The answer to that one's pretty simple. Yes. Right. Yeah. Sean, you got anything to say about that one?
Yeah, so I like the way that he worded that. There's guaranteed interest and annual dividend. He didn't say guaranteed dividend. There is no contractual guarantee for the dividend, but we like to go off of what history has shown us. And with the companies that we work with, they have a 125 plus year record of never missing a dividend payment. So we're not here to tell you that it's guaranteed. We're just here to tell you that they don't miss paying dividends.
There you go. I love it. Believe it or not, I think that's going to be it for us today. We're going to jump off. We're going to leave you guys to it. But just before we go, here's what you need to know. Click the link in the description of the video. Click on our bio. Click on the link tree in the bio and book a call. They're free. We're looking for your first name, your last name, and your phone number. So when I call you, I don't sound goofy because I don't know who you are, right? That's what I'm looking for. And then I'll call you and I'll answer all your questions, or Sean or Liz can help you. We'll walk you through it. We can literally walk you through it from start to finish. There's no cost at any point. And what we want to do is make sure that you get the information needed so you can save money and spend money at the exact same time using the infinite banking concept. There's that little black book I was going to pull out. Look at that little black book. It's this book. All the information that we are talking about today came out of that book. That's why we keep it around. That's why we have it handy. We appreciate you watching. We'll see you next time. Happy banking.
To the banking bro, said we couldn't make it, drink or settle, this the life we chose. Gave a lot of game, we never got a lot of things. Bow your head and say the prayer, we taught you how to be the bank.